Good evening, ladies and gentlemen, and welcome to the Equity Master Web Summit. Our guest today is Ajit Dayal. Ajit, as you're all aware, is the founder of Equity Master and also the chairman of Quantum Mutual Fund. Ajit's been a guest on several occasions in the past, and every time we've got a lot of questions from you all and fantastic feedback. And it's a delight to have him over again, especially at a time like this when the whole world seems to be again falling apart. And given from the questions that we received, several hundred of them, we thought it best that we host a webinar quickly and try and address your queries as much as we can. So without taking much time, I'll hand it over to Ajit. How we plan to structure it is the first part will be in which Ajit will make a presentation, and subsequently we'll take in as many questions as we can. So with these words, Ajit, over to you.
Thank you for having me on the show, and thank you for listening in so late in the evening. The title of the slideshow really is buy or sell, but there's another sort of byline which is not there, which should really state that you're not really buying or selling any security or any asset like gold or property. You're actually investing. All these instruments, whether they're shares, debentures, bank deposits, gold, anything out there, is a way for you to achieve your financial goals. Please keep that in mind. So this is not you need to be emotionally tied in that sense to this as opposed to an abstract buy or sell. If you are of a certain age, if you are of a certain stage in your lifestyle, you may actually be a seller no matter what the market conditions are out there. If you are at a certain stage, at a certain age, or of your lifestyle, then you will actually be a buyer no matter what the market conditions are out there. So I think you need to keep all of this in mind, and I will refer to this in a few slides towards the end. Let's sort of go back a bit in history and say, and look at what was said in a webinar that was hosted about a year ago in June 2010, when the BSE 30 index was about 17,000 or so. And at that point in time, our view was that given what was happening in India, given what was happening in the world in terms of potential fund flows, we saw that the market could actually hit a new peak and could breach the 21,000 level, and that the downside at that point in time we thought would be about 10%. So the index could fall from the 17,000 range where it was to about 15,000. And it sort of did that. We had, Ben Bernanke gave a speech at Jackson Hole in the US at a conference in August 2010, a year ago. Not the speech that he just gave this past Friday, but the speech of a year ago, in which he indicated that to get the US out of the mess, the US Fed would do what was dubbed QE2, quantitative easing 2, where they would actually go out and spend $600 billion in terms of flooding the world markets with that kind of money. And sure enough, as you can see in slide number 3, the Indian stock market took that massive run up from the fund flows that came into India. After Ben Bernanke's speech in August 2010, we got about $6 billion of foreign money in a course of 3 or 4 weeks, right through the middle of September. And that sort of took the market up to a new high in the first half of November 2010, where the market hit 21,000. And then, of course, fears of inflation, etc., brought the market down, and now where we are. Moving on again to slide number 4, to what was said in the January 2011 webinar, which we had. At that point in time, we indicated, again going back a bit in history, what happened at the Lehman crisis, when Lehman went bust, and then how foreign investors sold out of India, and the Indian stock markets collapsed by 50% in 5 weeks, and the Indian rupee lost 20% between September 2008 and December 2008. And then, of course, by May 2009 and of course May 2010, the stock markets around the world began to recover. The US economy also recovered, and everything sort of looked, sort of nice. And then till, of course, May 2010, May 5th, 6th, Greece gave the specter of sovereign nations going bust. And at that point in time, on May 5th, May 6th, the Swiss franc fell by some 15% against the dollar in a few days. So did the euro, and the dollar became, sort of strong. So the dollar, which was seen as a useless currency, was suddenly a safe haven because Greece was causing all these problems and Ireland was going next, and the fear that Portugal and Spain, called the pigs, PIGS, would sort of cause these problems. So the US dollar became a strong currency, for a while. And also in 2009, that's about 2 years ago, we had a not so good rainfall, and there were fear factors that our GDP would be affected by that. But that sort of came to pass. There was no impact on GDP per se. And India, sort of did well. The stock markets did well. So by Jan 2011, when we kind of look back in history, everything, there was still sort of uncertainty in the global environment. It was not as bad as the immediate post-Lehman crisis. But the fact that Greece could go bust, was kind of raised the specter that sovereign nations can also go bankrupt. And if so, what will be the impact of that on credit markets and stock markets? And on, again, slide number 5, the questions we asked ourselves then was whether the US economy was a real recovery or not. Was China a bubble? Was gold a bubble? Again, this is gold a bubble has been a question that's been asked for the last 10 years, every year by everyone. And gold has risen, I think, 11 years in a row now. And then, of course, on the Indian side, whether the Indian stock markets were overpriced, and whether we should actually start buying in Indian shares now, whether we should wait. Of course, we'd also started indicating by the end of 2010 and the early part of 2011 that the BSE 30 index, based on March 2012 earnings, could by July 2012, and the reason we choose July as a month is because that's the time when the earnings are announced and what is estimated starts becoming fact. And then based upon good earnings and based upon foreign flows, very importantly based upon foreign flows, could the index hit 31,000 by 2012? And I was called an uneducated moron for making that statement. And I guess I still have that badge or have that tag slapped on me because I still believe that the index could head in that direction. But on slide number 6, where were we at that point in time? In Jan 2011, we made the prediction that the index could hit 31,000 or some such number by March 2012. The markets have come down, as we know. And as we speak, markets are again in a very fluid state. There is nervousness around the world. The index cracked below 16,000, closed below 16,000 on Friday, August 26th, for the first time in a long time. Not since 12 months ago. So, you've got this nervousness back again in the market. A lot of it, of course, was led by the fact that not only is Greece at risk, but Standard & Poor, S&P, one of the big 3 credit rating agencies in the world, downgraded US debt, US sovereign debt from AAA to AA+. So an AA+, of course, is not bad, but it's no longer AAA. And there are now, I think, only 15 nations in the world which still maintain the AAA status, and the USA is not one of them. But most securities, most assets in the world are priced around US interest rates. So the S&P downgrade is very significant because the benchmark, in some sense, is being questioned. It's a bit like us being told that we may not be the children of our own parents. It kind of raises a fundamental question on the whole sort of financial structure of the world if the US debt is no longer AAA. That's one way to look at the impact of the S&P derating of the US sovereign debt. Going back to where we are today again, moving forward, if you will, to this month, August 2011, and what we expect in the future. Politics, we've always said, is very messy in India. There's a line from a Pink Floyd song called Mother, which says, "Mother, should I trust the government?" And if recent indications are anything, I think if Prime Minister Manmohan Singh had to stand for elections anywhere in India, he'd probably lose his seat. The Congress party would probably have a lot of people losing deposits, I think, if they were to stand for elections in India. Not only because Mr. Anna Hazare has come on and brought the issue of corruption to the forefront, but also because the Congress has supposedly or been, sort of have ministers or people in the party or in their coalition partners who've actually who've increased corruption to tremendous levels, as we've seen from Adarsh, Commonwealth, 2G Telecom, and more things that are coming out every other week. So, politics is still a major problem in India. And again, it's a problem in many parts of the world. We should not, as Indians, believe that India is the only place with bad politics. I think the US has terrible politics, and we've seen that, which is why S&P downgraded US debt. I think US has massive corruption. The corruption, of course, is at the level of Wall Street firms and banking firms and big defense companies and big industrial conglomerates. It may not be at the level of getting a license or getting a ration card, but it certainly exists. And please don't fool yourselves in believing that the US is a place full of angels. It's not. I think there are probably as many devils there as there are within India and in many emerging markets. So, politics around the world is bad, and also within India, I think is questionable. On slide 8, we go back to one of our favorite charts, which looks at India's GDP growth rate from 1980 across different governments, some of which were coalitions, which have been shaded in the pink color with a little asterisk at the bottom. And it shows that the real rate of GDP growth across each of these governments has been pretty stable and pretty robust and pretty nice. World GDP in this entire period grew at about 2.5% per annum. So we've got India's GDP growing more than 2 times world GDP over the last 31 years. And this too across various economic environments. You've had strong dollar, you've had weak dollar, you've had very high oil prices, you've had very low oil prices, you've had very high interest rates under the Federal Reserve Chairman Paul Volcker in the early 1980s. You've had free money that was started by Sir Alan Greenspan in the late 1990s and carried on aggressively by his disciple helicopter Ben Bernanke, who believes that throwing money from a helicopter is a good thing to do if it's required to save the economy of the US. So you've had different environments in terms of global economy. You've had different environments in Indian politics. You've had 2 prime ministers assassinated in this time period. You've had changes of governments at state level, city level, municipality level, whatever levels, federal levels. You've had droughts, you've had floods, you've had all sorts of stuff. And yet the economy has gone on at a wonderful, 6.2% average number, like we said, since 1980. So moving on to slide number 9, if you look at the Indian economy in that context, and you look at where we are today in the world, the line at the bottom, the greenish blue line at the bottom, shows the rate of change of growth in the US GDP on a quarterly basis year on year. And what that's really telling you is that the US economy has slowed down since December 2007. It went down post Lehman. Then, of course, Ben Bernanke threw a lot of money into the US economy. So there's been a recovery, and that's again tapering off because the effect of that free money is going away, and the US economy may enter into what many economists have feared since 2008, which is a double dip, that the economy doesn't do well, it recovers, it falters, and it falls back into a declining rate of growth, i.e. a degrowth, if you will, as it's called in India. And that could happen, which is why the recent talk of Ben Bernanke, which he gave at Jackson Hole in the western part of the US on this past Friday, is important because, he didn't say much. All he said was that I will try as a Fed to do what I can to help the US economy recover, but I need help from the government of the US, from Parliament in the US, from the Congress in the US, from the legislatures in the US who need to build policies to also give long-term rates of growth that are more sustainable in the US. So like India, the US has a bad political system which is disconnected from what the people want. And then the red line is the global annual GDP growth. And we didn't have quarterly numbers. It's not. We don't think it's compiled. So we got this from IMF Bloomberg data. So the annual rates of GDP growth rate again show the decline after Lehman, the red line going below 0, and then the recovery as emerging markets and the US recovered. The top line is India's quarterly GDP growth rate. And of course, it was doing very, very well pre-Lehman, touching nearly 10%. and then it declined to about 6% levels for one quarter, after Lehman, started recovering, headed back towards 9%, has clocked in at 8%, and now the estimates that are coming out from various economists is that the GDP will be 7.2 or 7.5 or 7% for the year ending March 2012, which is the current financial year that we are in, and we're halfway through that financial year roughly. I'd like to warn you about many of these forecasts that are coming out from the various economists, no matter which big Wall Street firm they work for or which bank they work for, or even whether they work for the World Bank or the Asian Development Bank or the IMF. All of these economists got India's GDP forecast completely wrong after the Lehman crisis. They all downgraded India's GDP. They had India's estimated GDP for the years 2009, for the year after Lehman, originally at about 9%. After Lehman, they brought the numbers down to 5% or even below 5%. All of them were completely wrong. India's GDP, as you just see from this graph, recovered very quickly after Lehman and clocked in at above 8% and even touched 9% in certain quarters. The only group that actually got India's GDP right was CMIE, the Center for Monitoring the Indian Economy, now of course called CMIE, which we believe understands India a lot better than the World Bank or Asian Development Bank or IMF or any of these high-paid economists working for the big Wall Street firms or the big banks. So when we see downgrades coming from that quarter, it really doesn't upset us at all as investors in the Indian stock market. If CMI was to downgrade India's GDP, that would be worrying, because we believe CMI really knows what it talks about a lot more than anyone else out there, largely because CMI is the originator of data. They send people out in the field and they collate their own data. Everyone else is basically using secondary data, using other people's data to come to conclusions. They are armchair economists in that sense. So we have a little less faith, and they're giving you opinions, and fine, we give you opinions too, just as I gave the opinion that the BSE 30 index could hit 30,000 or 29,000 in the next 10, 11 months. But anyway, the point is that India's economy is, in our view, quite sheltered from the US and also from the global economy to a large extent. There will be some impact, but it won't be a significant impact. The earnings of the BSE 30 companies, shown on slide 10, have been growing. Not in a straight line. Earnings don't grow in a straight line. Companies have to fight different environments. Sometimes we buy more cars or more scooters. Sometimes we buy less cars or scooters or shampoos, and that has an impact on companies' revenues and costing and profits. And ultimately, this is what's shown up in the red line. So the BSE 30 index, the estimates for 2012 March and 2013 March are here in the blue. 1198 is the estimated EPS for 2012 March, and 1399 again from Bloomberg. This is the consensus. All the analysts out there who report their data or talk about their views on the earnings of stock markets, of Indian stock markets. So all that data is gathered, collated, and you come to this sort of a consensus number, if you will. So this is not a quantum mutual fund number. I don't think it's an equity master number. I'm sure it's not. But it is a consensus number out there, and our numbers as equity master or as quantum may differ from this. But this is what other people are saying, if you look at it as an average on what's going to happen in Indian earnings, and it's going to go up. But of course, given the fact that there's been a downgrade of debt in the US, given the fact that there's been sort of turmoil in Indian stock markets, the dog loves to go and try and catch its tail. So you've got the various analysts now downgrading earnings. So here in this chart, or here in this table, if you look at 2012, the second row from the bottom, in May 2011, the estimate for March 2012 earnings was 1,334 rupees. By June 2011, the estimate had declined to 1,241, a downgrade. And of course now, as of the most recent data that we've got from Bloomberg, the estimates for March 2012 have further been downgraded to 1,198 rupees. So there's been roughly about a 5% slippage, in the earnings estimates over the last few months. and these estimates may continue declining, till over the next few quarters. So if there is noise in the market out there, if the stock market comes down, if there is fear of the repercussions on the Indian economy because of uncertainty in the global economy, many analysts may begin to downgrade their earnings estimates of the BSE 30 companies, which in the aggregate is now estimated to give a profit of 1198 rupees, and those earnings may start slipping down further, until we actually get the reported results by June, July of 2012. So keep in mind that there could be downgrades out there. This slide number 12, we look at the historical PE ratio of the BSE 30 index going back 10 years or so. On average, it is 17.65 times. If you look at the left side of the graph, it was below that. We came out of the tech bubble. We had 9/11 in America, when the World Trade Center was targets of the attacks of Bin Laden's group. You had SARS. You had this big fear about a global calamity because of a disease of SARS coming out of mostly Eastern Asia and moving westward and all over the world. So stock markets were really very cheap. I mean, Indian stock markets went below 10 times earnings in March 2003 on the left side of the graph. And then you had this big brick story. You had again Sir Alan Greenspan and Ben Bernanke putting more money in the US to get the world away from 9/11 effects and SARS effects. And the money flows sort of gave this impetus to emerging market stocks, emerging market assets, emerging market economies began to grow, and money flows followed that. The Indian stock market went up, it began to get expensive. Then you had the Lehman crisis, and then the markets fall very sharply, and then again you had more money coming in and the markets rise, and the PE ratio, the price that you're paying for every rupee of earning, again increased. And now again with the sovereign debt crisis that's coming out with Greece and US, etc., you've got fear factors in the world, and the PE ratio, the price that an investor is willing to pay for every earnings, or for every rupee of earnings in the market, is now coming down. So the PE ratio is coming down. So this is not a slide of earnings. The slide of earnings, and I'm going to flip it back, is on slide number 10. This is a slide of earnings. This is what's happening to earnings of the BSE 30 index. And slide number 12 is the price that people are willing to pay for each of those earnings, each rupee of earnings in those different years and time periods. So please keep that distinction in mind. Earnings are increasing. The price to earnings ratio, the price that people are willing to pay for the earnings of the companies, is all over the place. It goes above 25, it goes to 10, it goes all over the place. That's what makes and causes share price movements. Okay, very fundamental distinction. Again, slide number 10. If earnings come down, you should not be buying stocks. If PE ratios move all over the place, that is noise. That is someone's perception, someone's fear or greed about what is likely to happen in the future. That is emotions in the market. Okay? And slide number 13 kind of rounds up this argument that it is the madness of these foreign so-called FII, so-called institutional flows, which will determine the price of Indian shares. Unfortunately, the mutual fund industry, and I know because we run Quantum Mutual Fund, and we know the sort of thuggery that's happened in the industry over the last decade. Unfortunately, the mutual fund industry has done a massive disservice to India by not acting as a channel to take savings of Indians, growing incomes, growing savings, growing number of people getting wealthier. Yet, if you look at the column of net local fund activity, there is hardly any money coming into the Indian stock markets over the last few years from all of you all. Because the mutual fund industry, which is meant to be a fabulous and is a fabulous vehicle, has really been mis-selling products to you over the last few years. And rightly so, you've been fed up and you walked away from the fund industry, just as you have turned away from most political parties and most politicians because they've let you down. Whereas the foreign activity has been really very powerful in terms of determining the ratios. If you look at, for example, the year 2007, calendar year 2007, CY 2007, Foreign investors put in $17.6 billion into the stock market that year, and all of us Indians put in 3.2 billion, and that's a ratio of something like 5:1. So there was $5 of foreign money for every $1 of rupee money. It's like we don't have faith in our own markets as such. And again, so that made the share price of the Indian stock market go up. The BSE 30 index in that year was up 68.5% in dollar terms. Fast forward 1 year later, calendar year 2008, foreigners after the Lehman crisis became net sellers in India, and for the year they sold $12 billion, $11.9 billion. Indians bought $2.5 billion, but the foreigners were still big sellers compared to Indian buyers. So therefore, the Indian stock market had no way to go but to go down. So it fell 60.7% in dollar terms that year. If there are more sellers than there are buyers of any product, the price of that product will come down. So whether it's shares, whether it's used cars, whether it's laptops, whether it's apples, whatever it may be, if there are more sellers and buyers, simple economics will tell you, laws of economics, that the price has to come down to reach equilibrium. And that equilibrium was reached by the stock market declining to its lows and losing 60.7% in dollar terms that year. Again, 2009, foreigners bought, Indians actually sold, because in 2009 August, that's the time period when SEBI came out with the rule banning front-end fees. And of course, our wonderful distributors and our wonderful mutual funds in this country, sort of had this revolt, and everyone began to sell ULIP products. At that point in time, they didn't sell mutual funds anymore. But the point of the slide again is that the amount of what foreigners will do will determine the share prices in India. If foreigners buy, share price have a very good chance of going up. If foreigners sell, share price have a very good chance of going down, because the local money is too weak to counter the foreign money as of today. We hope that will change in the future, but as of now that is true. In August, till August 19th, about $1.5 billion of foreign money has left India in that month to date, MTD, in that 1 month. And that's caused this sharp 14% decline in the Indian stock market in dollar terms, in that period. And over the last 1 week, I think another $500–800 million has been sold, and hence the stock market in India has gone down further. Going back to May 2010, the very last row, that's when Greece indicated that they may go bust. So the foreigners got nervous and they sold everything which was non-home country. So they took their money back to their parent country. So they sold India, they sold China, they sold everything. $2 billion went out of India in May 2010, and the Indian stock market lost 7.6% that month in dollar terms. So the foreign money flows will determine whether Indian share prices go up or whether Indian share prices go down in the near term. In the near term, keep that in mind. Again, what the foreigners do is not necessarily right or wrong, and they've changed their tune many times. Keep in mind again that the foreigners were selling in India post-Lehman. That is probably the best time to buy Indian stocks. So the foreigners whose headquarters may be USA will do what is right for their balance sheets and for their clients from a US perspective. And from a US perspective, in 2008 post-Lehman, it made sense to take risk off the table, to sell anything which was a fringe investment. So if you're American, you want to hold all your assets in US dollars and be safe. You want to recoil in your shell. You take a snail, you take a tortoise and you touch it on its head, it recoils in its shell. It goes back to home country. You take foreign money which is in India and you touch it with some fear, it recoils and goes back to home country. So that's what's happening. It doesn't mean that it's wrong to buy Indian shares or that it's bad to buy Indian shares. All that it means is that the tortoise is putting its head back in its shell. It doesn't say that the tortoise is saying the world is a bad place. The tortoise wants to be safe in its hard shell in its home country. And that's what's happening. So don't worry about what FIIs do. Don't use it as a guide in terms of what you should be doing. You need to understand not only your own personal balance sheet and your risk capacity and what your needs are for the future, but you need to understand the earnings direction of the Indian economy and Indian companies. That is very important. On slide number 15 again, just to show you the roller coaster ride since the brick story began. In 2005, Indian stock markets go up. Lehman happens, it comes crashing down. green shoots appear in the world. People look like the world is safe. Ben Bernanke is flooding the world with money. People are throwing money back at India because India's GDP has done very well. And now again we're at the cycle where the Indian stock market reached a new peak of 21,000 in November 2010, slipping now because of inflation and fears on what's happening in the world. So yes, you need to worry about what's happening in the world to one extent for PE ratios, for price movements, but in our view, a lot less for the earnings direction. Let's take a quick look at what's happened this year so far in the Western world. The Dow Jones Index, from the start of the year till August 19th is down 7%. All these are in dollar terms to equalize currency movements. The S&P and Nasdaq are down 11 and 12. Mexico is down, Brazil is down, Euro is down even more, Spain is down, everything is down. Of course, gold is not down, gold is actually up. And Berkshire Hathaway, Warren Buffett's stock is also down. Extreme right column, how have these different indices around the world, stock markets around the world and assets around the world done since the time of July 2007, which is roughly the first sign of risk coming back in the world. That's a year before the Lehman crisis, when two Bear Stearns hedge funds, which were dabbling in the mortgage market in the US, were basically, were in trouble. One fund got rescued, then one fund went best, one fund went bust. And you can see from this list that gold has been the only asset class that has done really, really well. Brazil has done well too, because Brazil is a commodity-based country to some extent. So commodities have done well, iron ore has done well, and oil has done well, and Brazil has iron ore and oil both. So it's done well. And that's a good indicator of, of kind of fear and opportunities that may arise when risk gets repriced on a substantial basis in the market in the long term. What's happening in the East? Again, for this calendar year, all stock markets are down excepting Indonesia and Thailand and Philippines, the smaller Asian cousins, the lagging Asian cousins, because these economies are seen to be much more domestically driven. And if you go back to the extreme right again of the column, where you see that how these three stock markets, again since July 2007, have actually done very well. Jakarta's done very well. For Philippines up 41%, Thailand up 41%, Philippines up 32%. I would like to point out here that the Quantum Long-Term Equity Fund has also done really well since then. It's been up about 29% at that point in time. And just to give you a sense of the index, the BSE 30 index, one row above, has been down about 8.2%. But in general, most Asian big markets have done not so well. The smaller Asian markets have done well. And of course, you can always find gems in the market. If you look at Infosys, has actually gained 0.5% since July 2007, whereas Reliance is down 32% since July 2007, and even ICICI is down 21% since July 2007. So of course you can find gems in markets that may protect you and make you money, and that's what a job of a fund manager should be, or of you as an analyst who are subscribing to Equity Master Research or as an independent investor should be, to identify those gems. And going back again to slide number 18, sort of going forward to slide 18, again putting India in a relative context, rounding up the slide, the world index since the start of the year has been down. India has fallen more than the world indices. In rupee terms also, as local investors, we are down 21%. In dollar terms, the BSE 30 index is down 23%, so there's been about a 2% loss in currency. And even the Quantum Long-Term Equity Fund has had nowhere to hide and has been down 19% so far this year. Oil has come down because of fears of a global recession. Gold has gone up because of fears of central banks around the world printing more money to try to rescue the world, as has silver. And even the venerable Berkshire Hathaway has lost so far this year. The last sort of slide in terms of global movements, page number 19, the troublemaker has been the US. It was the US debt that got downgraded by the S&P, by the rating agency, on August 5th. And data that we have compiled for the fortnight, for the 2 weeks ended August 19th, is that the treasury bonds have actually gained by 19%, and the last two rows, gold has gained and silver has gained. And all share prices around the world have come down, including, of course, oil has come down because of fears of global slowdown and global recession. So we've got a situation where the person that caused the trouble, or the nation that caused the trouble, is the US. US debt has been downgraded. Typically, if you lend money to your neighbor, and if I was to show you some data tomorrow that your neighbor is actually not a creditworthy person, or he's not as creditworthy as you thought he was AAA and the best paymaster out there, but I give you data and I say, well, in my opinion, he's been downgraded one notch and he's AA plus, he's no longer AAA, i.e. there is some risk that his parents or his family may not allow him to repay debt, just like there was risk that the US legislators were fighting in the US Congress about whether the US government should or should not honor its debt payments. So while the US had the ability to pay, its legislators were thinking of not paying, which is why S&P downgraded. In a similar way, when your neighbor may be able to pay you, but what if his parents began to tell him, beta, it's okay, don't repay the debt, there's no bad thing in the world if you default on debt, right? You will be more nervous about giving him money. And if you did give him more money, you demand a higher rate of interest, and any debt that he has with you is worth a little less than what it was before you realize that his parents were telling him all the wrong stuff of not repaying debt to you. Well, in this strange case, the US Treasury bond has actually gained. People are rushing in to buy the debt of a country where the legislators have actually discussed for a few weeks in front of TV cameras on why it is no big deal if the US defaults on its debt. To me, that is crazy. That is not, markets, we believe, or we've been told, are always right. That is a wrong statement. Markets are not right. Markets are what they are at any point in time. That is true. That does not mean they are right. People may be willing to value AOL and Yahoo at hundreds of billions of dollars of market cap, or WorldCom, in the tech bubble era in 1999-2000. That did not make it right. Yes, it was the market price, it was the market value. It doesn't make it right. But this table shows a couple of things. One is that the base asset, US debt, should actually be losing value, but it's gained value. And shares around the world, rightfully so, are losing value because there is uncertainty and no one knows where the world economy is going. The Indian stock market is down worse than the world stock markets, most world stock markets, because the foreigners dominate the price of Indian shares. So they are selling, right? And the Indian analysts, the analysts who track the Indian companies, are downgrading earnings per share because also they are fearful of what will happen in a global economic slowdown environment. Though we hope, we have shown you from our slides, that India's GDP, while it will be shaken or stirred a little bit, will largely remain unshaken and unmoved from what happens around the world, and therefore we believe that earnings of Indian companies will still head upwards, northwards, at an accelerating pace. They won't be declining, they'll be gaining in the next few years. And therefore, if earnings are gaining, in our view, earnings are increasing, you should be buying shares, not be selling shares because others are selling for whatever their reasons are. Slide 20, we do not believe that the US economy or the US legislators have fixed the problems. Yes, there's been this dead cat bounce, as you can see on the chart of capacity utilization. Money was fed into the system, so there's some economic recovery, but that is stalling in our view, and that will start coming down. And I shouldn't say our view, I think many people out there have that opinion, that the US economy is slowing down. I have many friends in America. I just spent a few weeks over there. You walk around, you talk to people, people are hurting. Not Wall Street. Wall Street is making tons of money, bonuses are back in business, everyone's back to where they were in a pre-Lehman stage by and large. But Main Street America, as it is often called in the press, the people working in factories, the people working in real jobs, are actually hurting big time. And there's some big solution that is required in the US, which has not yet been prescribed by the legislators or by the Fed. So we don't have much faith in the direction of the US economy for the next few years till we see something more substantial in terms of changes in the US. And slide number 21 indicates that. You can see that the factory, while capacity utilization increased, unemployment has not come down. So yes, factories are humming. They are making workers work more and paying less effectively. They're not hiring more people. And that's a fundamental problem for any economy. If there are a lot of unemployed people and those who are employed are not earning enough in salaries. Again, skip the Wall Street crowd out. They're earning enough in salary and bonuses. But if you talk about much of mainstream America, then they cannot consume. And if they cannot consume, then that economy is going to be slowing down because they'll be rationing their consumption. And 2/3 of the US economy, more than 2/3 of the US economy, is based on consumption as opposed to based on exports, etc. So if the consumer dies in America, the US economy has to follow suit and has to wilt away. But on page number 22, a very colorful slide and a very important slide about what had happened in India right from the time of the from the pre-Lehman crisis. So in Jan 2008, Indian markets were at a peak of 20,500. Then there were fears of inflation at that time in 2008. The price of oil and rice and wheat began to gallop upwards. Indian stock markets came down, lost about 30% in value over 6 months. By end of June, early July 2008, fears of inflation receded. The price of oil had peaked at $150 in middle July, started to come down. Price of rice had peaked, price of wheat had peaked, began to come down. Indian stock markets began to go up, began to surge because inflation hurt it in the first half of the year, Jan to June 2008. Inflation coming down would benefit the stock market. So the Indian stock market started going up. The pink portion shows Lehman. The Lehman crisis hit, and you can see that massive sell-off, about 50% loss in US dollar terms in 5 weeks. And of course, then the currency lost another 20% by the end of the calendar year. Indian stock markets remained down. Then you have the green area at the extreme right. There was a recovery in the US a bit, green shoots as they called it. Indian stock market surge. Then you had the election results announced in May 2009. The UPA coalition government, led by the very honest Prime Minister, won a second mandate. And then you had this fantastic rise. And of course, you've now got the uncertainty again. So that's been the cycle of how money movements have shown what could happen to Indian stock markets in different economic environments. And Mark Twain said this, that history never repeats itself, but it does rhyme. And you can see that on slide 23. We've taken the red line, which is the BSE 30 index, from its January 2008 peak to present. Right? And at the bottom of the scale is the number of days since then. And the blue line is the BSE 30 index from its November 2010 peak of 21,000 to the present. And the similarity is actually quite stark. Fears of inflation from November 2010, the price of onions and rice and wheat and oil went up in India. And much of the discussion, and for the first half of the year, for this calendar year, has been inflation. And Indian stock markets, like many emerging stock markets, began to come down in price. Then fears of inflation sort of went away. Indian stock markets went up a bit. And now we've got sovereign debt crisis or sovereign debt fears. And that's again brought the Indian stock markets down. So the blue line seems to be fairly closely tracking what the red line is doing. Now, it could happen that tomorrow the US declares bankruptcy or Greece declares bankruptcy. It could happen. Or a currency falls out of favor, the US dollar or the euro or someone out there. And there's a crisis. And the blue line goes right down, just like the red line did. It plummets. It could fall 50% in 5 weeks, just like the red line did when Lehman crisis happened in 2008 September. So keep in mind that an index of around 16,000 where we are today, in theory, the index could actually go back to 8,000 tomorrow if all the foreigners decide to sell. If foreigners sell $10 billion in 1 month or $10 billion in 2 months, the Indians, our local Indian power, is maybe 2 billion a month, 1 billion a month. We can't absorb their selling. More sellers, fewer buyers, price of that product comes down. More sellers of the BSE 30 stocks or any Indian stock, fewer buyers of us in India, the price of shares will come down. What will make them sell? It is not the earnings downgrades. It is not earnings failure in India. It is fear factor of something outside India. So it can come down. Here's a man who's saying the index can be 29,000, 30,000 or whatever by July 2012. And here's a man who's also saying that please recognize that because of some fear of something happening outside India, right, the Indian stock market could collapse by 50% in a month, as it has already done 3 years ago in September 2008. Of course, the Indian stock market could also collapse if there was a war between India and Pakistan, for example. It doesn't have to be an external factor. It can be an Indian factor, which causes foreigners to sell. But it is the foreign selling that brings it down, not the Indian selling that brings it down. That is the key point. It is the foreign buying that brings it up, not the Indian buying that brings it up. And which takes me to slide 24, that in the end, in the long term, it is the underlying earnings that will determine what stock prices are. Again, the foreign money will come back to India as they did post-Lehman if they see earnings of Indian companies growing based on better GDP growth rate. So if the foreigner sells today, like the tortoise puts his head back in the shell, like the turtle puts a head back in the shell, again you put some grass in front of them, some beautiful sweet green grass. After a few hours, the head will come out. And the head will say, yes, that grass looks pretty good, let me go out and get it. And the foreign money will come back in. Will come back into India. It's the power of foreign money flows that will determine the share prices in India. And again, going to slide number 25, that's what's caused the wild movements in the markets, a combination of earnings, which has been relatively steadily moving upwards over the same time frame, but the flows of foreign money have been in and out for different reasons. So share prices never go up in a straight line. They're very jagged, and they go all over the place depending on fear and greed. So we've got this revised forecast for the BSE 30 index of 28,500. So I think I began with about 31,000 or maybe 29,000. It went up to 31, now down to 28,500. Again, these are not my forecasts. Please understand mathematically what we're doing here. We're looking at the earnings of the BSE 30 companies as estimated by people out there, the Wall Street firms, the Indian brokerage houses, their estimates. We're taking, and I'm going to move to that slide right now very quickly, which is slide number 10. So we're looking at this chart, earnings estimates, and onto this chart we are putting this PE ratio, which is already there. What is the price that people are willing to pay for earnings in the past? What has that price been? So, and we estimate one over, you extrapolate or you multiply one with the other. You can assume different things, and we made assumptions on these things for those who read what I say. That foreign flows will determine this. There should be nothing in the global environment that should scare people. And if foreigners like India, they will pour money in. Because the Indian story is based on GDP growth rate, which is not being shaken by foreign events. The Indian story is based on good earnings growth of Indian companies. You apply a multiple of 17.5 times to an estimated earnings of the index, and that is the average 17.5 times, you'll get a 23,000, 24,000 index. You'll be a bit optimistic, as foreigners have been. You apply a 20 times earnings estimate to India's earnings, or a 20 times PE ratio to India's earnings, you'll get the 28,500. It is a pure mathematical exercise. Please don't treat this as a target. Please don't treat this as something that has got to happen. It is something that could happen. Do I believe in a 28,500 number or a 31,000 number? No. Do I believe that Indian stock markets will rise because earnings will increase? Definitely, I do. And yes, people have written to me saying, how can you, Mr. Dayal, how can you, Ajit, give an index number and a date? I give an index and a number and a date for you all to think about what can happen, for me to think about what can likely happen. I can tell you that I'm today 51 years old. I can tell you that probably at the age of 70, I'll have a weaker voice. I'll have a likely weaker body. Firstly, I hope I live to live that long. I'll have a weaker body. So I'm giving you an estimate of what is likely to happen. assuming, of course, that I do nothing silly. I don't go out on a smoking binge, I don't drink too much, I don't take drugs, I don't kill my body, so I can live to the age of 70 or something. These are all assumptions we make as we go along. So think of it as longevity of your portfolio, longevity of whether you should or should not be in the Indian market. Should you be a seller of shares or should you be a buyer of shares? If you have the risk, if you have time on your side, you should be a buyer of shares irrespective of what the foreign money does at these price levels. If the index today was 35,000 and I showed you this graph, I would tell you to be a seller of shares, because I'm telling you that the more fair value, the more likely, the more possible, plausible value of the index is going to be 28,000, because the PE ratio at 25 is not sustainable. It'll probably head towards 20 or 17 or some such number. It'll tend to that normal. It could be some local event that makes foreigners sell and brings the price down and the index down from a 35,000 level to a lower number. It could be a foreign event that brings it down. But the point is, please don't confuse this with a prediction. I am not in the prediction business. I'm not trying to give you numbers for your F&O trades. I don't understand F&O trades. These are not strike prices for you to get in and get out of. This is for you to understand the trend and direction that could happen. There's a big assumption in this line. You can see it right there. The blue line, which is the index, has very rarely touched the red line. In fact, for the last decade, it has not touched the red line. Whereas for it to get to 28,500, it's got to actually touch the red line. You know, what if it only trends over there? I'll still be happy, because if it trends there, maybe the index will be 24,000. Great for me. Good enough for my long-term investment view. So please keep in mind that these are not target numbers for you to buy and sell some F&O option stuff. These are really trends on where we are. So I won't dwell too much on this, but yes, I would like to defend that number of what the index could be in July 2012, about 11 months from now. Again, saying that the macroeconomy, I think, looks pretty good in India. Politics will be messy, but that's the other. And I was very surprised to read Mr. Rahul Gandhi's statement. I've not read the thing verbatim, but at least the press reports of it. He seemed to have, he indicated, kind of giving a view on the Anna Hazare movement, that he is doing a game changer. I think he's probably trying to destroy his own prime ministership candidate by saying what he said, in my very, very humble opinion. But anyway, I think that, I think there's a lot happening in India. I think the politicians are touting, and many people in the intelligentsia are touting, that the parliamentary process is right. If the parliamentary process was right, India would not be in the political and corruption mess that it is today. I think we have to recognize, and you can do this by profiling the people who are in parliament, that parliament processes in India, in theory, have been fabulous. They haven't worked. There is a people's movement, and at the end of the day, the parliament represents the people. The politicians believe that they need to represent the people only in the 30 days that they seek re-election. The Anna Hazare movement is in some sense reminding them that they have a term of 5 years every time they get elected, and they represent the people's views for each day of that 5 years, not only the days when they come back to visit their constituency to give handouts, to win votes, and to get re-elected. Again, there could be black swan events of US meltdowns and all that's happening in the world. I'll touch upon this a bit later when I talk about your personal portfolio and your view of the world and your assets and your view of life. But do not let those things. You can't wait for a black swan event to occur. You can't wait for a crisis to put all your money to work. You can keep some money aside for a crisis, but you can't keep all your money aside for a crisis. If you were scared, I mean, we all know we're going to die one day, so we don't lie down in bed all day. We get up and we change our clothes and we have showers and we shave and we go out and we meet and greet the world. It doesn't mean that you're going to stop greeting and meeting the world because you know you're going to die. You will try to make sure you don't die. You'll look at the roads on both sides of the road when you're crossing. And when the traffic light is red, for God's sake, like an honest truth reader, you will stop and you will not challenge the red traffic light, etc., etc. You live your life. You have to invest. You can keep some money aside for a black swan event that may be happening now, but you must keep on investing. As I indicated before, at a PE ratio below 15, India, now my views are very strong buy. At a PE ratio 15 to 20, India is interesting. You can find value. at a P ratio above 25, India, in my view, gets to be expensive. Those are very broad sort of numbers that we can discuss at a later date. The other sort of criticism, and I'll come to some of the risks in the story, are that we've got high interest rates in India. Well, this blue line is a 10-year bond in India, going back from 1990. How much interest would you earn from buying a Government of India 10-year bond paper? And the red line is a wholesale price index. So a 10-year interest rates, in my view, are not high, they're actually low. The inflation rate is more than the interest rate in India. Therefore, you're actually getting negative rate of return. 100 rupees in a government bond is earning you 8.25% in a year. So you get 108.25 rupees at the end of 1 year. 100 rupees, a cost of things that you buy today, is increasing. The inflation rate is closer to 9%. So it's going to cost you 109 rupees to buy the same basket of goods 12 months from now. And your investment only gave you 108.25. So you're actually out of pocket by 75 paise at the end of year 1. You have to spend 109 rupees to replicate the same consumption basket that you had today. 1 year from now, inflation is 9%. That's what inflation 9% rate means. And the red line, as you can see, the inflation rate is more than the interest rate. So I don't think high interest rates are a risk. In fact, with a global slowdown, we've already seen oil prices coming down. We believe many other commodity prices will also decrease, and therefore inflation will come down. From a company perspective, their cost of raw material for many companies will come down. The commodity producers will get hit. Those who are selling oil in a free market, those who are selling iron ore or steel in a free market may be hit. Of course, the steel producer who is selling steel, his price comes down, but recognize his iron ore price will come down, his coal price will come down. So he may be able to maintain or protect some of his margins, though his volumes may be affected with the slowing global economy. So these are all different dynamics that affect various companies. But from a personal or from an economic perspective, we don't believe that there are high interest rates in India as such. And here's proof of that, because inflation is more than the interest rate. Therefore, interest rates are not high. In the middle of the chart between 94 and 2000, the blue line was high at about 11-12%. Inflation was 3-5%. Therefore, the real rate of interest is the blue line minus the red line. So real rates of interest were 12% if you look at the blue line at a point in time in 1998, and say the inflation at that time was 6%. So 12 minus 6% was the real rate of interest in those days. Now the real rate of interest actually is negative. So it's not a bad thing for India in our opinion. Gold and silver, they've done very well, as people who've read The Golden Truth, written by my colleague in Quantum Mutual Fund, Chirag. And if you haven't, you should sign up for it. We've always been talking about gold for a few years as an investment. We think of gold as a store of value, as a currency. And here sort of it proves it, that gold has appreciated since the Lehman crisis by about 17.5% each year. Silver has appreciated even more, by 28%. There was a breakout about 12 months ago. The red line of silver has shot up very dramatically. It peaked in March this year, came back down a bit, and again inching up. And the index has actually lost about 1% per annum since the Lehman crisis, or rather since 2008, since the start of 2008, not the Lehman crisis per se, but that year. Gold from its peak in 1970 has picked up, but of course the BSE 30 index has done very, very well in India. Over the last, again, this month is for 379 month data. So over the last 30 years, you've actually seen the index give you a return of 11% per annum. You've seen gold give you a return on the extreme right in the top rows of 3.7% per annum. And silver has just about given you about 0.7% per annum return every year for the last 31 years that they've been in, since the gold price last peak. And we believe that gold has actually retained its store of value against the world's strongest paper currencies. So this chart shows the price of gold in 3 currencies. The price of gold since 1980 in US dollars has appreciated by 2.94%. The price of gold in Swiss francs has appreciated by 0.6%, i.e. you would have been better off owning gold than owning Swiss francs. You'd have been better off owning gold than owning US dollar for sure. And the Japanese yen has actually gained against gold. You have been, if you look at the red line, it's below zero. And in the row, it shows you in the data on the extreme right on the top, gold commodity JPY, extreme right, gold is actually lost 0.69% per annum against the Japanese yen. You'd have been better off being a buyer of Japanese yen in 1980 when the Japanese story, when the Japanese export story sort of took off. Japan currency was in that sense a much better asset than gold over these years. So please do not think of gold as this idiotic metal, as this relic as it has been described. Even Mr. Warren Buffett, who I respect a lot, has got very negative views on gold. In our view, the role of a currency is multiple. Currencies are a unit of measure. I can tell you what a laptop costs and what an iPad costs and what a banana costs, all measured in rupee or dollars. So it's a unit of measure. I carry currency notes in my pocket. It's easy to carry. It's portable. I transact with them. I can give Rahul money. Rahul can give me cash. I can give you guys checks, cash, whatever, electronic or hard currency. It is a way to exchange, a medium of exchange. I sell you my services, or Equity Master sells you its services in an electronic form of subscriptions. You electronically give them rupees. They electronically give somebody salaries of people who work for Equity Master, who then go shopping in a shop and use debit cards, credit cards, or hard cash to buy things. It's a wonderful portable way to transact and measure everyone's skill set. An analyst at Equity Master gets paid a certain salary. The subscription of Equity Master is a certain amount of price. So it's a good way to price and measure things. But the other point of a currency is that while it is sitting in my pocket, while it is sitting in my bank account, while it is lying under my mattress, it should not lose its store of value, its buying power. What does an onion, or the price of gold in some sense, the price of gold in 1971 in US dollar terms on August 15th was $33 an ounce. Today that same price of gold is now hovering between around $1,800 an ounce. Effectively, the US dollar, if you held $33 in 1971, today you can only buy 2% of what you could in terms of gold grams with it. If that gold, if in 1971 the 33 US dollars bought you 1 ounce of gold, today the 33 US dollars buys you 0.02 ounces of gold, right? Because the price of that dollar, the value of that dollar while sitting in my pocket for the last 40 years has been eroded. That is one of the major reasons to own currencies, and that we all hold paper in our pockets. If we knew that the value of our rupee, or value of dollars, or value of Swiss francs that we hold in our pocket was going to decline by 50% tomorrow, i.e. if one banana cost me 5 rupees today, and tomorrow the banana seller is going to price it at 10 rupees, I will rush out today and use all my rupees to buy as many bananas as I can at 5 rupees. And not wait for tomorrow for the price to go to 10 rupees. However, if I knew that the currency will maintain its value, then I will remain an owner of that currency. And the paper dollar is not a reliable currency. In 1971, August 15th, 1971, August 15th coincidentally is India's Independence Day, but August 15th, 1971, President Nixon of the US took the US dollar off the gold standard. He refused to honor. If people shipped US dollar bills to him, he was supposed and obligated by treaty to give them 1 ounce of gold for every $33 that they shipped to him. As of August 15, 1971, President Nixon said, "I am sorry, gentlemen, you can own as many dollars as you want, but I will no longer give you 1 ounce of gold for every $33 that you measure me, that you send back to me." And he took the US off the gold standard. And since then, the US currency, as I've just demonstrated, the price of gold has gone to $1,800 an ounce. The US currency has lost 98% of its value. 98% of its value. Gold has maintained its value. Please ask your grandparents, for 1 gram of gold, how many shirts could they buy in 1970? How many samosas could they buy in 1970? How many kilos of rice could they buy in 1970? Please ask them. They have a store of knowledge in their heads. Ask them this question this evening when you go home to them. Or if you already are home after this webinar, please ask them. Go back and then look at today's price of the rice and all, and measure the same thing in how many grams of gold it would take to buy that same amount of rice, the kilos of rice and the number of shirts and the number of samosas or plates of samosas. And I can wager a bet that you will need pretty much the same ounces or grams of gold, and maybe even less for many commodities, for many things. The price of airline tickets has come down. You need less gold grams today to buy airline tickets than you have needed gold grams to buy airline tickets in the year 1972. I know, because I made my first trip to the US then in 1972, and I measured this in price of rupees and gold, and I need less grams of gold today to buy the same airline ticket. So there'll be certain commodities where, because of excess supply, your currency, the gold currency, has gained value, has retained value. There'll be certain commodities like property prices where you may need to pay a little more grams, but you count that in rupees, you got to pay a lot more rupees to buy that same per square foot in South Bombay or Delhi, or Noida over the last few decades. So gold is a store of value. I'm not saying it is the only store of value. The Japanese yen has proved that it's as good as gold, and the Swiss franc, in fact, Japanese yen has been better than gold in this time period. And even the Swiss franc has said that it's nearly as good as gold, but the dollar has shown that it is not as good as gold. Again, going back to the last few slides, the rationale for investing in gold has to always be as an insurance. You don't have a price target on gold. I don't have a price target on gold. I can estimate, I can tell you, I can give you views that it may be $3,000 a troy ounce from $1,800. But you don't buy gold because it's going to go up. You buy gold as insurance, the same way you buy life insurance. If you buy life insurance, you don't want to die tomorrow, but you buy it just in case something happens to you, God forbid. At least your family has some payout. Same thing with gold. You buy gold just in case the US government and Ben Bernanke goes mad and he goes out and prints more money, and then gold retains its value and it much more than the dollar or paper currencies will, and it acts as an insurance for your portfolio. So if the stock market goes down because of a Lehman crisis or a Greek crisis, gold will go up. You buy it as a natural hedge, just as life insurance is a natural hedge for living and not for dying in some sense. And this graph illustrates, also that. Again, it's an illustration. We're not saying these are the exact numbers. Please, all disclaimers to be told to you. Any number that you see for the past is not a prediction for the future, but it is really a view that we have. It is a guide. You look at history. It may not repeat. It should rhyme. So gold should tend to go up when there are crises in the world. Gold will go down when the world is fine. So I always tell people, buy gold today. Put 10, 15, 20% of your assets in gold today. But make sure, of course, you have stocks and other assets. And the day you buy gold, pray hard. When you sleep that night, say, hey, Bhagwan, tomorrow morning when I wake up, please make the price of gold collapse by 50%. Pray hard for that. Do all your meditation, all your yoga, and draw all the spiritual power you have to pray hard for that. Because the price of gold goes down, it means the world is fine and the world is doing well. If the world is doing well, your stock market portfolio will double. So you'll more than make up, as this slide indicates. Your stock market portfolio, in theory, could go from 80 to 160. Your investment in gold will halve from 20 to 10. At the end of the day, your 100 became 170. And you're still doing fine. But if the world was to sink, if there was a debt crisis in the world, your stock markets of today of 80 become 40, and gold goes through the roof. Maybe 20 goes to 60. And you still maintain a total value of 100. Your portfolio or your total wealth is not been eroded because stock markets collapsed, because property prices collapsed, because gold acted as a wonderful hedge. Your family is not affected because you bought that wonderful life insurance policy. They can continue looking after themselves long after you're gone because you were sensible enough to hedge your annual earnings, to hedge your monthly earnings by buying life insurance. That's the same view to look at gold. Don't go into gold with a price target, please. And you must allocate for the long term. That's one lesson that we've always learned. Your allocation is very different. This is roughly my allocation. It's not quite precise that way, but I mean, a few percentage points here and there. But these ratios kind of indicate what I'm doing with my money to some extent. But this is, again, for every person, it's very different. You must talk to a financial advisor or the chartered financial planners, as they're called, IFAs, CFPs. You must talk to people, or you must do your own exercise. A lot of it is common sense. I will make a pitch here for Personal F, and I'll make a pitch for Equity Master here too, and for what we do in Quantum Mutual Funds. We try to teach you all through various writings of being sensible. We give you all tools to study. It doesn't take difficult. It's common sense. It is so easy to understand all the stuff we are saying. It is really common sense, but you must then look into your heart, look at your family situation, see what allocations work best for you, and stay with these allocations for long periods of time until there's a change in your life. Don't let the market movement determine your allocation. Don't say stocks are down, I must buy stocks. That's the wrong thing to do. Maybe your life situation is such that you can't even afford to risk 1 rupee in stocks. You don't want to own a single stock. You want to own everything else but stocks. Because say you've about to pay your child's education for the US, or you're about to buy your house next month. You don't want to risk that money in the stock market. Stock markets can go down 50% in a month. We've seen that already in 2008. You don't want to risk that. That's gambling. So any investment you make, any security out there, any asset out there, whether it's property or gold or shares or government bonds or bank deposits, are to be used by you for your objective, not for the sake of being invested in stocks. Please keep that in mind. What do we worry about? This is kind of a dashboard on page 34. We worry about the budget a bit, but less and less every year. Monsoon has been good, so water table levels are high. India won't have a monsoon, won't have a water shortage for this year. Pakistan and India, a waste of time. I wish both the politicians and everywhere around the world talk more peace and talk less rubbish, but that's a wish. It hasn't changed. It's as bad as it was before. Local politics, corruption is as bad or bigger than it was before. It's a curse around the world. China is a worry because they and India both demand more capital, demand more commodities, demand more time and attention from portfolio investors, and demand more capital flows. The US Fed, of course, a big thing. Depending what they do, the whole world can get dislocated, which is why having gold is a good thing for your hedge also. And the fact that India has 150 million youth who will soon seek jobs in the next 10-15 years is a source of increased worry for us. We worry where those jobs are. We think the government must come out with proper policies to employ more people in rural India. So whenever they give the rural employment guarantee schemes, we actually like them. We know there are leakages. That doesn't mean everything is bad. You may have a leak in your water pipe. Doesn't mean you throw away the water pipe. You try to fix the leak. So the rural employment guarantee schemes we think are a good way to transfer wealth from urban India to rural India. Taxation is also a great transfer of wealth, provided of course taxes are used for all the right things and not kind of leaked along the way. But taxation by itself is not bad, and helping youth in rural India per se and by itself is not bad. But of course corruption and leakages along the way are very bad. So the disclaimer of course is very, very small. I apologize for that. I will request my legal department to put this up as a PDF version, as a standalone. I apologize. I am a big proponent of people reading disclaimers, and the print is so bad with my failing eyesight at the age of 51. I certainly cannot read this. I'm sure even otherwise you all cannot read it. My apologies. We'll make sure the disclaimer is bigger in a separate PDF file and is accessible along with the PowerPoint. And if you all wish, you all can ask for it by email and it will come to you all too. With that, I'm sorry I took so long, but I will...
No, thank you, Ajit. Your perspective always helps us get a better understanding of what's happening and plan our portfolios better. We'll quickly take up the questions that have come in. We have a lot to cover, and we'll try and finish as many as we can in the time left for this presentation. So let's start with the first question. Is this US crisis worse than the last subprime crisis that happened in the US?
I think that this crisis in the US is a continuation of the subprime crisis. The subprime crisis, to go back in history, was caused by a couple of things, one of which was that there was a desire by the Wall Street firms to generate higher revenues, profits, etc. So they began to lend money to people who could not afford to actually buy their own homes by giving them teasers like no interest for the first 3 years, etc., etc. So people gullibly bought their homes and everything else when they couldn't really afford it, and the Wall Street firms sold these mortgage securities, made a ton of money in the creation, origination, selling, trading of these securities. When the whole thing came to unravel, when the US economy began to slow down, as any economy goes through a natural cycle, the US economy began to slow down in 2007 actually, and then people couldn't afford to repay some of their loans. Then the bad debts increased in the banks, etc., etc. And then you saw the Lehman bankruptcy from all of this. So there really was an effect of that. The solution to that could have been to shut down pretty much all of this Wall Street stuff. And a few were shut down. But a few were let private, a few were left remaining, and the Goldman Sachs, for example, has become more powerful today. JP Morgan is more powerful today than it was pre-crisis because they became the buyers or the saviors of weaker institutions, and the big have actually become larger, as many books have actually been written on this now. And the US, rather than resolving that issue by forcing the cost of capital to be increased so that risk-taking is off the table, flooded the market with more money to ease liquidity, which was not there in the system, because companies still needed money to run their businesses, and there was that freeze in the system, so they pushed money in. The money was probably pushed too aggressively and to the wrong people. A lot of Wall Street ex-CEOs run the Treasury Department of the US, and this is again documented, that CEOs of Goldman Sachs and Merrill Lynch and Morgan Stanley and Citibank at various times in history have been finance minister equivalents in the government of the US. So they've created policy to help their own firms and their own wealth and their own stocks. Again, this has been documented and very well written by other people in a much more exhaustive manner. So this bailout, in some sense, took the pain from the Wall Street firms to the balance sheet of the US and the balance sheet of the US taxpayer. So what you're seeing since then is the Federal Reserve had a $600 billion balance sheet pre-2008. It has a $2 trillion balance sheet today, right? And growing. There will be more QE3s or QE4s most likely if this same pattern carries on. So there's a huge increase in money supply, because if a central bank increases its balance sheet, i.e. it's putting more money in the economy, and that has caused, in my view, this sort of distorted economy. And the US is continuing at one level as a government, spending more on defense, spending more on being the peacekeeper to the world or the warmonger of the world, depending which view you have of the US. And as Bill Bonner says a lot in his daily in his daily reckoning, and he's written a fantastic book on this, which is The Empire of Debt, that all empires one day have to pay the price. So you're seeing that, again going back to your question, that Wall Street could have been, you could have limited the pain to the banks and the financial system. You transferred the pain to the US taxpayer and the US balance sheet. And now S&P is rightfully asking the question that with all this debt on your balance sheet, Mr. US government, and all these obligations, how are you going to repay it? So there's become a sovereign crisis of the US itself, as opposed to a sub-crisis of US banking system. Now the US sovereign itself is being questioned about its ability again, we're not saying the US is the default. What S&P is saying, and what many people are arguing out there, is that the ability of the US to repay its debts, if it keeps on its current course, is questionable. So the current course needs to be changed, which is why state governments, city governments, municipalities in America are shutting down police stations, shutting down fire and departments. I read the other day that about 250,000 teachers and teacher assistants have lost their jobs. So they are now try to think of the repercussion of this for the long term of the US. You need to build a competitive economy by having educated people. Of the 400,000 state employed people who've lost jobs all across America since 2008, 250,000 are teachers and teacher assistants or librarians. These are homekeepers of your education system. Now, sure enough, there are enough who say, oh, these are only babysitters. The American system is a bad system and my kids learn nothing in school. They're only just kept over there in a relatively secure place for that. Be that as it may, 250,000 secure babysitters have been let go. So there will be a repercussion on this in the long term.
Let's take this a little forward. When the last crisis happened, you had Bear Stearns, and then after a while you had the Lehman and the whole world crashed. And in between there was almost a period of time where people thought the worst was over. Now we've had this US downgrade, and immediately following the US downgrade, you had a lot of people talking about this is a great time. It's an opportunity for India, for Indians to go and invest and put money to work. And the situation seems to be becoming worse. How do you think it's going to pan out? Is it going to be a prolonged problem? Is it going to get solved? Your views?
Sorry, are you talking about opportunity for Indians to buy assets in America or buy assets in India? Yeah, I think again that Indian economy, as I've just shown through in a few slides, is quite divorced and quite decoupled from the rest of the global economy. And I go back to the calculations that we've done. I've written an honest truth on this in the past, that the total amount of money that is there in the the total amount of sort of money that is sloshing around the world markets, some of it will find its way to India. The Indian economy is quite delinked, so that when that money flow comes in, share prices will go up. As long as there is GDP growth rate, which is not linked too much to the Western world, and I don't think it is, as long as there is earnings growth in India, that money will find its way. So this crack is an opportunity to exploit the turtle or tortoise behavior of the withdrawal to the shell that is happening yet again, as happened in 2008. So yes, it is an opportunity. But having said that, you don't buy shares because shares are cheap. You buy shares because your personal situation allows you to have certain risk capital allocated to shares, and therefore you're buying shares. The fact that they are cheap makes it even a nicer argument, but it cannot be the sole argument for you buying shares. That people must realize.
Now, I still need to try and get that answer from you. If you had money today, if you had surplus money today and you were allocating for your need, let's say, would you put all your money to work now given this correction and we are below 16,000 levels, or would you like to wait a little bit while longer?
Again, if I'm a first-time investor, I would wait. I would put probably 50 to 75% of my money to work right now in one day. Because if I'm a first-time investor, my exposure to equity is zero. And if my needs indicate I must have equity, if my allocation was 80% equity, 15% liquid gold, and 5% liquid fund, I would put my equity to 60% very quickly. Right? And that other 20%, I'd kind of wait for that extreme event that may or may not happen in the next few weeks, months, year, we don't know. And I'd put that money in a liquid fund to switch to equity or to mutual funds, at the right time. As far as gold is concerned, in the same way, if I've got nothing in gold today, I would not buy all the gold that I want today unless I got my equity position up. So if I had 60 in equity and I wanted to have, on an 80-20 ratio, I wanted to have 20 in gold and 80 in equity, then I would put proportionately 15 in gold. Right? But I would keep that allocation. Whatever that allocation that makes sense for you, I would work towards that allocation right now if you're a new investor. Right? And I'd put, like I said, 50, 75% of that money to work right now. And the other 25, 20% I can wait for that black swan event to do it, so I'd have it in my mattress, very safe, before I allocate again. I hope that gets...
that's what I was trying to get. The next question is... if the dollar continues its depreciating slide, how much would it affect the FI inflows considering the rupee gets inflated? So I guess that's the question. He's referring to how much of an impact would the dollar movement have on FI flows?
Yeah. I mean, if the dollar is going to get weaker, I guess the question is against the Indian rupee. So if the dollar is going to get weaker against the Indian rupee, then a US-based investor would rather have his dollars in Indian rupees than in US dollars. So he will ship his money out of US dollars to those currencies which will strengthen relative to the US dollar. And if that includes the Indian rupee, then that's all the more reason why money will flow into India. So it has some impact, but I think that equity owners or buyers of shares don't buy shares for currency movements. They buy shares because they believe in the earnings or the EPS of the companies that they're buying in for the future. A bond owner, someone who wants to buy a government bond, he will own Indian debt, because his calculation will be that the Indian government is giving 10-year bonds at about 8.25%. the US government is giving me 10-year bonds at 5%. So I can earn 3% more by being in Indian paper. Plus, if the currency of the Indian rupee is going to strengthen against the US dollar, I get that extra benefit.
Okay.
So it will be those people who worry about currencies will really buy government bonds more than equity stocks.
So basically, you're saying that the impact of exchange rate movements on stock returns is not a very big deciding factor.
No, I'm not saying that. Sorry. I'm saying that the impact of exchange movements on stock returns is a big factor, but it's not the reason why people buy.
Okay.
People will, you don't know about the impact till it actually happens. So, but you will not buy Indian shares on the expectation that the rupee will appreciate. You're buying Indian shares because you expect Indian companies to earn more than US companies are earning in terms of EPS. Right? And you will buy the shares. It may happen that the Indian currency goes the wrong way and becomes weak against the dollar. So when you translate your losses, when you translate your money back to US dollars, you've actually got less dollars. That may happen. But you won't buy it on the negative view or a positive view.
Okay.
You buy shares for earnings growth. You buy bonds for yields and currency appreciation. So the impact on, but if there's a US investor who's an equity investor, if he believes that the US dollar is weakening, he will look for assets outside the US, but he won't necessarily buy assets for strong currencies. That's what a bond investor will do. There's a subtle difference there.
Yeah. So I think what comes across in your presentation and even now is that you think Indian equities have a good outlook from a long-term perspective.
Yes.
And I know you've spoken that you're looking at trends. So one reader wrote into us and said that if we were to simply compound the return from the Sensex at 15% or some such number, it comes to like 70,000 index value in 5-10 years from now. That doesn't sound realistic, but is it realistic?
Of course it's realistic. If you look at what happened to the index in 1979-80 when it was created, was 100. So now it's 16,000. But that's still about a 19% compounded number. Now, if I told someone in the year 1980, I did not because I was too young to understand that hey, listen, the index will grow by 18%, 19% a year and could be 16,000, they'd probably shoot me as this man's a lunatic. But it's not. It's just a number. Don't get hung up on the number. Don't get hung up on 28,000 or 30,000 index number. Think of what the EPS is. And it's that earnings you're buying. If India's economy is growing at, on average, 7% per annum for the next decade, or 6.5% per annum for the next decade, if inflation in India is going to run at about 6% per annum for the next decade, you add the 7% GDP real rate of growth, you add the 6% inflation, you get 13%. That becomes the nominal or the current price growth of the Indian economy. If the Indian economy's revenue growth of 13% is a reflection of sales of companies, right? GDP is a reflection of all economic activity, including companies.
Yes.
So let's take that the GDP reflects companies' revenue growth rate. So at 13% then is what the revenues of companies are growing at. Let's assume that if revenues grow at 13%, everything else being equal, the margins are the same, interest rates are the same, no efficiencies, no loss of efficiency, none of that stuff. But everything is the same. Ceteris paribus, a wonderful word in economics, all else being equal. Earnings will grow by 13%. And and if the number of shares outstanding is the same, your EPS grows by 13%. So with an economy growing at 7% real rate of return, in 6% inflation, you are effectively have a chance, no matter how silly you are, to participate in a stock market where earnings of companies should on average grow 13%. Now, if you're a little smarter analyst or a smarter fund manager or a smarter investor, you will identify those companies that are either growing faster than GDP or that are creating more value for shareholders through acquisitions, bolt-ons or through operational efficiencies. But that is better than the average of 13. So in my view, the index, which is supposed to be a reflection of larger companies, therefore a little better than average, should be better than 13%.
Okay.
And if people like us, and if I look at the management team of Quantum Long-Term Equity Fund, the investment management team and the research team, if we really believe we're smart, then we should be outperforming not only the GDP number, but even the average of the better companies in the BSE 30, which is supposed to be a little superior. So therefore, the earnings expectation from our subset is 15 to 20%. So 13% should be the economy, maybe 15% should be the BSE 30 or BSE 100, and a quantum long-term equity portfolio is built really on companies with 15 to 20%. And that number should, in long periods of time, show superior performance at the NAV level. That's how investors need to look at it, not at, what is my rate of return going to be from this. And yes, you can look at that, but you're buying earnings, and that earnings give you the rate of return. Look at the earnings all the time.
I think you touched upon something very important when you said that the BSE Sensex companies can be assumed to be relatively better managed. And what we've experienced and we've seen from a lot of emails is that even within equities, people are not allocating well. When there is a lot of greed, you find people just buying up small cap stocks in disproportionate amounts and mid cap stocks. And when the cycle turns, even temporarily, these stocks get wiped out or they have very large losses. What do you think should be an ideal allocation within that 80 rupees of equity money?
Well, as someone who's a founder of Quantum Mutual Funds, I'll clearly make a statement to allocate more to us. There's no doubt about that. Again, but you have to understand our philosophy and our approach, and not get caught by the madness of moments and the madness of crowds, that fear and greed that you mentioned. But the way to look at it is you have to have a basket of maybe 6 to 8, maximum 10 mutual funds, in my opinion, if you're a fund investor. If you're investing directly in stocks, you should have, depending on your time and your interest, anywhere from 15 to 30 individual stocks in your portfolio, because you've got to spend a lot of time tracking the stocks that you own and also tracking stocks that you do not own today but you wish to own one day. So it does require a lot of time as an individual investor, and groups like Equity Master and other research houses out there give investors information which they can cull and then decide whether they believe that information and then act accordingly. And groups like Quantum Mutual Fund give tailor-made solutions of long-term equity funds and diversified funds for that. So I think if you're an individual investor, you should have between 15 to 30 stocks maybe, and you should have certain disciplines and guardrails. And if you're a fund manager, you can take a view of having 100 stocks, or as in the case of Quantum Long-Term Equity Fund, where they take the view that there should be between 25 to 40 stocks, and no single stock can be more than 10% of the portfolio. So it's a very disciplined approach. Now you may decide to take that same rule as an individual investor, or you may decide to take a punt and say, I don't care if one stock is 50% of my portfolio, but then recognize that one stock could collapse in value by 50%. For those who had Pantaloon or Suzlon or the real estate companies, Unitech and DLF or Satyam as a big chunk of their portfolio, they must have felt the pain. Of course, you'll feel the pain even if it's 10%, but 10% when it halves becomes 5% and your loss is 5%. But when you have a 50% position in one stock and it halves, it's a 25% loss to your portfolio. All else being equal. So you have to work out your own levels of pain and comfort and risk and your desire to sleep or not sleep well. But if you're investing in mutual funds, in our view, 6 to 8, maximum 10, diversified mutual funds are great to own. And you can add in that 10, 1 or 2 small cap emerging market. I call them more gambling funds because no one really knows what's happening. We at Quantum really haven't found a way to identify small cap companies that can be tomorrow's emerging leaders or tomorrow's winners or tomorrow's successful companies. I think a lot of it is luck. And I speak as someone who invested in Infosys and Z and NDTV and Mastech, and all of them did very well. Some did fabulously well. But that was luck. I had the luck of being in 4 investments when they were at the very early stage of their cycle as companies. And the 5th company that I invested in those days was a company called BITV, owned by the Business India Group, which went bust, where we lost all our money. So, we haven't found a process, a disciplined process to identify small companies that can be big companies. And there may be other fund houses that have. We haven't. So we would really urge people to have maybe 70-80% of their portfolio in what we would consider as large cap or more well-established companies, and only 10, 15, 20% of their money in sort of, punting, if you will, on this theme of emerging companies or small caps or whatever it is.
Okay. Uh, Coming back to the Sensex, there's a question which pats us on our back. Equity Master is a very informative site. Thank you. The question is, could you please shed some light about the bottom of the Sensex? How low do you think it could get? And I'm not sure whether you're comfortable, but could you talk about some sectors which you like from a long-term perspective?
Sure. Again, all of this is revealed in the portfolio of Quantum Long-Term Equity Funds, so no sort of secrets there. As a group, Quantum as you know, a value manager, we tend to be long-term, and we also focus a lot on managements. So, for example, we don't own a single Reliance Group stock. We don't own a single SR Group stock. We have shied away from real estate companies by and large because we don't find transparency. We have shied away from many infrastructure groups because, again, we don't find transparency. So we have certain views, and if you were to ask me about the index, how bad can the index be? Well, one is, like I indicated during the course of the actual the PowerPoints, that the index could, like it did in 2008 September, could collapse by 50% in 5 weeks. So we are 16,000 levels, somewhere around that level today. Can the index be 8,000 in 5 weeks' time? Theoretically, yes, it can. If the foreigners begin to sell and they sell $10 billion worth of stock in the next 1 month, that's where the index is going to be very clearly. There's no doubt about it in my mind. That's what will happen. Will the foreigners sell 10 billion? I don't know. That I'm not an expert on trying to guess that. But like I said, will the turtle take back its head or the tortoise take back its head in its shell? I don't know that, but it could. So in theory, from a foreign sale, an index could collapse. It is also possible that certain stocks in the index may decline a lot in value and therefore bring the index down. Until, of course, the people who run the index take it out of the index. So Satyam lost about 70% of its value in one day in January 2010. Now the index makers took it out of the index before it caused further damage. As they did it for Unitech and DLF and all these other companies, each time they in and out, each time they fall, they're taken out of the index. So of the various indices. So it could happen that a stock begins to fall very sharply and the index gets hit to that extent. But before the full hit is shown on the index, the people who look after and create the indices take it out. So I mean, in theory, there are many companies in the index which could, because of bad accounting or fraudulent accounting or bad business practices or bad business strategies, come down a lot in price, and they could come out of the index because of that. So the index can fall for many reasons. One is stock specific, that these stocks are bad, but the decline of that index will be limited because the stock will come out of the index, or a broader view that the foreigners are selling and everything in the index collapses. Every stock comes down, the index collapses.
What do you think is the chance that foreigners will sell like they sold in 2008?
You're asking me to give you a probability of people being insane. The probability is 100%.
Okay.
I think the probability of an index declining by 50% over a 5-year period is 100%. It will happen. I cannot tell you whether it will happen now, or 10 years from now, or 3 years from now, 1 week from now. But it is going to happen. Because as long as the Indian markets are driven and ruled by foreign flows, we remain hostage to that. Right? Just as the US economy is hostage to oil prices, just as the US economy is hostage to China buying US debt. So just as the US economy is hostage to this view that consumption is the best thing in the world and spending your time at the malls shopping is the best thing in the world. So as long as you don't do things to break these realities, you remain hostage. What the Indian government must do very quickly, very, very quickly, is encourage money flows into mutual funds. So SEBI started that under the tutorship of under the leadership of Mr. Bhave, to make Indian stock markets a safer place to invest. The current SEBI chairman, Mr. UK Sinha, is also making steps to ensure that the stock market remains a safe place to invest. So this $350-400 billion of Indian domestic savings, right now only 1%, 2% finds its way to stock markets. But if 10% of that money, $30-40 billion a year, finds its way to the stock market, then what the stock market, what the foreign investor does becomes less relevant and maybe even irrelevant. And what the local investor does becomes a lot more relevant. I am looking forward to that day. And by the way, when that day happens, please don't forget the Quantum Long-Term Equity Fund.
Okay, let's move to or real estate. Interest rates are going up. The future doesn't look all that bright. Job layoffs, in the papers, are peppered with stories. Where do you see real estate prices headed right now?
Real estate prices should have been 30-40% lower. We've been saying that for a long time, particularly in South Bombay and certain parts of the capital region in Delhi, etc. But they're not falling. They're not falling because there is still the wonderful, coterie of the real estate developer, the politician, and the bank managers, the branch managers, in this case being of PSU banks. It used to be of the foreign banks, now it's of the Indian banks, because the foreign banks post-Lehman have stopped lending by and large to Indian real estate companies. So that lending has been substituted now by the Indian banks. So as long as this link is established because of the political friendships and the corruption in the system, I don't think property prices will collapse. If the Indian government, and the government is the largest shareholder in PSU banks, if the Indian government was to tell real estate developers, listen, Mr. XYZ, you have 20,000 flats unsold, I want all my loans back in the next 1 year. No more rollover of debt. I'm not going to renew your debt obligation to you anymore. Give me back my money. You go and sell your stock. And if you don't sell the stock, I'm going to seize that stock. And I, the bank, will sell it in an auction in the market price. The minute they did that, prices would collapse by 30% in Bombay. 30% in 1 day.
And people will buy them then.
And people will buy. At 30% you can afford it.
Yep.
So the price may begin to inch up again. But it will be driven by demand as opposed to driven by corrupt politicians and corrupt real estate developers. I mean, we're seeing this wonderful Anna Hazare movement happening in the country where everyone is saying we want to stop corruption. I must even request those who attend these Anna Hazare meets, I've not attended one myself, but those who are there, I want them to question how many bribes they have given for their license. How many times have they been stopped by a cop when they broke a red light and they paid a bribe? How many times have they stopped at a red light and not gone through a red light? You must stop that corruption internally. In a very similar way, we've got the system where the real estate developers keep on with one mouth talking about the government not giving them land, the government making things difficult. I think this morning or a few days ago, Mr. Mantri made a statement that how the price of property would come down in India if there was if there was less corruption in the system, and he's right, it would, because even to buy the land and to convert the land and to get all the licenses, there are bribes, and he mentioned that. He said, I pay between 10 lakhs and 1 crore as fees, he very politely put it, in the system. But he did say, and he made a very nice statement to that effect. I would venture it one step further. If Mr. Mantri, and I don't mean him specifically, so I'll take that away statement from him, so I apologize, but in general, if real estate developers stop begging their friends in the political circles and the bank managers to roll over loans, and they actually repaid the loans they meant to pay, and they sold their stock by raising cash to repay the loans, prices will collapse a lot faster and a lot more than the bribing of the land. Yes, that also will help. So while we're trying to clean up the whole system, let every developer also recognize that while the government gets its fees and gets its bribes, if that's the way to put it, for rezoning, the real estate developer is getting huge profit margins because in some way his connections, he may not be paying bribes, but his connections with the bank managers and the political system allows him to keep prices at an inflated level as opposed to work at market forces.
Yeah. We've already spoken a bit about gold. You said even like Bill Bonner says, and you've articulated very well, you buy gold for bad times, you buy stocks for the good times. Where do you think, if you had to put a price to gold 5-10 years from now, where do you think it's headed?
Well, I'll counter that question by asking everyone out there what they think is going to happen with the banks in the world. If the central banks in the world, in the US and Europe, are going to continuously print more money to take themselves out of the debt or to postpone that day of reckoning, then gold will keep on going up.
Mr. Bernanke just stopped short last night of announcing that. He just said he has tools available to him, but he didn't announce a QE3. But if it were to happen, you think that would be another trigger for gold and other assets?
Yeah, I think it was in 2002 when Mr. Bernanke made the statement. I think it was 2002. There was a paper that I read where he indicated that the cost of generating a US dollar bill is nothing. And I've written an honest truth on that. Whether you print a dollar bill with 1 on it or one with 6 zeros, which makes it $1 million bill, the marginal cost is nothing. But the $1 million bill is $1 million. And the cost is that putting the printing ink of those 6 extra zeros and a few commas in between. So, if that's the way central bankers think, and Mr. Ben Bernanke has written this, that is the way central bankers should think, and he's also called Helicopter Ben, because he's even said that if the economy is in trouble, he has no issue of dropping dollar notes from a helicopter, so people can collect the dollar notes and go out shopping. So if that is the attitude and approach of Ben Bernanke and other central banks, then gold will keep on going up. Can gold double in the next 6 months? It could. Can gold double in the next 3 years? It could. Again, gold is a function, it's a currency.
Yeah.
So its exchange rate is a function of the stupidity or the smartness of the other currencies out there. Just because gold is a metal and is not a paper that you can fold in your wallet does not mean it's not a currency. Gold is a currency. The fact that central banks in the world have not printed it doesn't make it less of a currency in terms of less favorable of a currency. It is still a currency. It is a currency that central banks in the world cannot print so easily as they can dollar bills. So there are political reasons why gold is not accepted and endorsed as a currency. Culturally, gold is a currency. Don't ever doubt that. It's been a currency for hundreds of years, as is silver. Right? But I think gold, in my view, is more of a currency than silver is, because silver has a lot more industrial use, and therefore if the world economy slows down, the demand for industrial use of silver will slow down, and therefore the price of silver will be muted to that extent. So I always tell people, it's not that I don't like silver, but recognize when you're buying silver, you're buying somewhat a gold characteristic of a currency and somewhat a copper characteristic of economic activity. So you're not buying a pure hedge, you're buying again half equity and half gold. So if you're putting 20% in silver, it's like putting 10% equity and 10% in gold. So really you got 90% equity and 10% in gold. So don't dilute the reason why you're buying the precious metal. Buy some silver if you want for fun. And that the sort of argument of silver is that, silver is cheaper than gold. Yeah, nominally it is, because 1 kilo of gold is more expensive than 1 kilo of silver. But that doesn't mean 1 kilo of cotton is less than all of those. Doesn't mean the price of cotton is going to go up a lot. So that's a wrong reason why the price of silver is moving up, because it's seen as a poor man's gold. People then should buy rubbish from the Radiwala because he's selling a lot of old newspapers at a cheap price. So I think we should be a bit careful about how we extend this logic of silver going up.
Yeah. Okay. You've been traveling off late. You're back in India after quite some time. What are foreign investors? How are they looking at India right now?
I think our messaging to foreign investors is what I've explained in the Web Summit here. A lot of these slides is what we discuss and showcase to the foreign pension funds or sovereign funds or long-term investors whose money we try to manage in Quantum Advisors as a sponsor of the mutual funds. Our views are that India's GDP is growing, India's earnings are growing. I think many foreign investors accept that. And, much to their credit, post-Lehman, the few clients that we had in Quantum Advisors actually increased the allocation to India. So we were buying on their behalf at 8,000, 10,000 levels of the index. Even at this stage, we are telling our foreign investors that if they have 100 to allocate to India, they should allocate anywhere between 50 to 75. And if there is a black swan event, if Indian stock markets collapse like they did post-Lehman, then they should put a lot of more money to India work then. When it was pretty much the same message we gave to our investors, international investors, pre-Lehman. We told them, give us a fourth, a third, or a fifth, a fifth, a fourth, or a third of what you want to invest in India. Post-Lehman, we told them, give a lot more money that you want to invest. And then that money is done well. There was some trimming for some clients, some people added more. But recognize that they come from a different base. If their allocation to India over the next decade has to only grow, is not going to come down. So the way we talk to them is a little different, because we know they are very early in the cycle of allocating. We know they need to get comfortable of dealing with a strange country called India, thousands of miles away, with all the political noise that they are not used to. We Indians are used to the noise, so they are not. So we have to guide them into Indian waters a little more slowly. You're an 18-year-old man, you will jump into the river. You're an 18-month-old baby, you won't throw the baby in the river, you'll make the baby come in slowly. So the Indian domestic investor can jump into the stock market depending on their risk appetite and their where they are in life. But the foreign investors, the 18-month-old baby, they need to be slowly brought into the river. So we talk to them a little different in terms of the allocation numbers, but we certainly show them the same slides and the messaging is the same. So whether we manage 500 rupees for you in the quantum long-term equity fund, or whether we manage $50 million for you as an international investor, we pretty much give you the same messaging and the same slides and the same arguments of why you should be investing in India.
And what are your cash levels now?
For the fund, it's between 11-12 percent in India. For our international clients, it's about the same. So we're double digit, but sort of the low end of double digit.
And
to give you the peak, I mean around we've been as high as 30% cash for foreign investors. For our foreign investors in the last quarter of 2010, in September 2010, we were 15% cash. But again, now that cash level is 11-12%, and we haven't found, again, keep in mind that a 16,011 index is pretty much where the market was in Jan-Feb 2011. This year a little below, but that's where it pretty much was, Jan-Feb level 2011, and where it was in Feb 2010. So we are not cheap. I mean, dramatically cheap is if the markets fell post-Lehman 8-10,000. We again hope it doesn't go there, but it could. That would be a screaming buy, in that sense. So at 16,000, there is value. We're finding the value and we're buying and we're putting the money to work at these levels.
Just one quick thing. Overall, the world, how do you see it? How do you see US stocks going forward?
Again, a lot depends on money flows. The US stock market linkage to money flow and money printing is very high. Ben Bernanke prints, money has to find its way to go somewhere, so it goes to stocks. If we're all sitting in a closed room and we all take out our wallets and we count our money, and suddenly from the fan or from the light, or in this case from Mr. Helicopter Ben, he enters the room and he doubles the amount of money we have, and we each use the money. Now we've got twice the number of currency notes, and we have to buy the same laptop and buy the same cell phones and the water bottle in this closed room. The price of everything will double.
That's right.
So that's what happened. Mr. Bernanke has printed more money. People have found places to put that money. One of that is the Dow Jones, and the Dow Jones index and stocks have gone up. I'm not belittling the fact that there are many companies out there, Apple for example, which has given great products and has done very well. But by and large, it is not earnings that is driving the stock market. It is money flows that is driven the stock market. I think the US economy, we showed through the few slides out there of capacity utilization and more importantly job creation or lack of job creation. Unemployment is very high. The US in our view is has to have some significant changes in serious policy making. There have been discussions about should the US spend $1.2 trillion on defense every year. That's about 8-9% of its annual expenditure as a country, as of its total GDP. Sorry, so 8% of GDP on defense is a lot of money. $1.2 trillion.
That's the entire country, India's output.
That's India's entire output, and that I think is more than the entire defense spending of all the other NATO allies. It's a huge number. So I mean, if and the US has done it because they've been seen to be or want to be the police keeper of the world. And and to some extent it's our fault if something goes wrong. If we have a fight with China, guess who we'll appeal to? Will we appeal to Africa? Will we appeal to Germany, or will we appeal to the US? We'll appeal to the US. If we have a fight with Pakistan, who are we going to appeal to? We're going to appeal to the US. So the fact of the matter is the world still wants the US as a policeman, and maybe the world should start paying for it. Maybe of the $1.2 trillion, we need to start paying a share of that bill. But something has to happen. The US cannot afford this grandiose war machine, defense machine that it has, nor can it afford the pensions and the benefits that is giving its state-owned employees or even the private pension employees. So there's a lot of changes. I think the state of California itself has a $250 billion hole in terms of the pension employees to the Californian people within the state of California. Just one state. If you count this whole thing, I think Bill Gross gave a statement the other day that if you count all the liabilities of the US government that which are there, right from medical to retirement to social security to the pension plans of all the people working for the ex-government, etc., for the governments, is some $70 trillion. that is 5x US GDP, 5 times US GDP. Now that's not sustainable. So there has to be a renegotiation of these IOUs, that I cannot owe the world being the police keeper anymore. I'm going to scale back. I cannot afford to give you, Mr. Californian retired pension employee, all these health benefits that I promised you. We have to renegotiate. So something significant structural has to happen, which means that the US consumer is going to get poorer. There'll be less jobs created. There'll be less health benefits given, less pension checks coming out to people every month. US consumers will have less to spend. People have to recognize that fact. That is the painful medicine, but that is the true and proper medicine. The other fake medicine is printing money. Keep on printing money and saying, no problem, I'll give you the 70 trillion I owe you by printing more money. But that you only cause the inflation, which is the other medicine which is painful to the middle class. Is not painful to Wall Street. They get their bonuses. They get their wonderful salaries. People like us in the field of finance are very well protected from this, because we are this skill set which in my view is being rewarded extremely high over the last few decades. And even Warren Buffett has said that he's lucky that he's living in an era where his skill set as a huntsman, as a spearman, is not being, this question as a caveman. He'd be eaten up by a lion or an elephant or all very quickly. But he's living in a place where his skill as someone allocating capital and being an investor is being rewarded, and he's being unduly rewarded for what he's doing, which is why a great man that he is, given a lot of his money away to charity.
Okay, last question, we're really out of time. Outside of Indian stocks and gold, is there any investment opportunity that you see out there?
I haven't really studied it, to be honest. And I look at a person living in India. To me, you want to diversify your assets by being things outside of India. The question is what? You don't want to own sovereign debt of any nation out there, because they will not pay you the money back. That's a risk. You may want to buy some multinational stocks which are not listed in India. That is possible, because even the few multinationals that are in India are getting delisted. But then you're not. But then you may want. Then you're buying a whole basket of the world, some good, some bad. So you may want to look at the more obvious ones. Again, you look at Warren Buffett's portfolio, the American Expresses, the Wells Fargos, this thing, McDonald's. He used to own a McDonald's. I think he made a huge mistake by selling it. But those kind of stocks. You look at those favorite names out there. You could look at that. And again, which stocks to buy over which cycle, which company does well. There are all those risks. Or maybe you buy a fund which buys and does that on your behalf, which is fine. The other thing that I would generally not look at is property outside India. Having said that, I will look at property because again, it's a lifestyle thing. And if you do believe that you're going to live in America or live in Europe or live somewhere because your children are going to live in Australia or study there, and you may go to visit them, then you may want to buy some property for them sometime, because those prices have come down, and there probably is a 10-15% downside to property prices now in the Western world compared to where it was in the peak. So you may want to buy a property for your children if you want to, instead of buying a property in India, you give them education, they leave India and they go and live there. But then you're giving them an exit option, for India. So again, I would look at those small things, but I would not buy property stocks in the US or Europe. And again, if I look at Asia, I don't understand much of how Asia moves. I don't understand much of what makes China tick. So I personally don't really have any China stock holdings or any Asian stock holdings. My holdings are Indian stocks. I own Indian stocks. I own some multinationals that I described of the US in very, very small amounts. But my view is that India is going to do very well. Your diversification is gold. Gold is an international asset. It's priced in a global currency, not only in Indian rupees, it's priced in all currencies in the world. That's your global diversification, in my view. You don't need to diversify. And you could, like I said, you could own a few multinational stocks. But really, in my view, you don't need to diversify too much.
Great. We need to end now. We're really out of time. Thank you very much for coming down and making time for this web summit, Ajit. Very learning, very helpful. And there are a lot of questions unanswered. Maybe we'll pass on some to you and you could maybe take them up in the next Honest Truth.
Sure. I apologize for going on and on about the same things many times, but I will look at the questions and I will answer many of them in Honest Truths in the future. Thank you very much.
Thank you. Thank you. And thank you to all who participated in the Web Summit. It's been a pleasure hosting this event and having you all over. Just to conclude, if you like the Web Summit and you think that it could be beneficial to your friends and family, please do share the link to this presentation with them. There is a URL, the social networking buttons which are given below, which you can click on and share with your friends and family. And if you have any feedback on how we could further improve the Equity Master Web Summit initiative, please write directly to me at rgoel@equitymaster.com. With these words, once again, thank you for attending and participating in the Web Summit. I look forward to seeing you for the next edition. Thank you.